Section 4 disclaimer, chaos version. Listen up, Lodu and Legends. Before we dive into the circus of bubbles, scams, and market crackheads, let me clear one thing. This is not financial advice. I'm not your broker, I'm not your daddy, and I'm definitely not the RBI giving you shitty fixed deposits at 6% while inflation eats 10%. If you take this lecture, run to Zeroda, throw your rent money into some stock because buy Nebola, and then cry when your portfolio looks like Cardike's love life. That's on you, not me. This whole thing is for education plus entertainment. Education because you'll finally understand how history keeps repeating while retail keeps repeating mistakes. Entertainment because I'm about to roast you harder than your ex roasted your WhatsApp blue ticks. If you think one PowerPoint or one lecture will make you rich overnight, congratulations. You're the exact clown the market was designed to eat alive. Miss why the market doesn't care about your feelings, your EMI, or your TradingView Premium subscription. She'll pump, dump, and leave you dry while Sudhanshu is still drawing trend lines like it's kindergarten art class. So buckle up. I'm your narrator, not your nanny. Take notes, not loans. And if you're looking for shortcuts, go join the Get Rich in 7 Days Telegram groups with Cardike. You'll lose faster there and save me the headache. Final warning. Everything here equals satire, roast, and survival guide. If you gamble your savings after this, don't DM me screenshots crying, "Bye Mara 2 lakh Gaia." You weren't robbed by me. You were robbed by your own greed plus stupidity. Section 4 introduction coming in hot. Simple English, more sarcasm, pure chaos roast, so Lodu and Legends don't dare yawn. Section 4 introduction. Topic 2, rise of coins and banking, still poor retail edition. So here's the scene. Lodu and Legends. Humanity finally upgraded from let's trade goats for rice to let's carry shiny coins. You'd think this was progress, right? Wrong. This was just the first premium scam subscription Miss Y sold us. Coins were supposed to be easier than barter. Instead, kings and emperors started playing PUBG with metals. One day it's gold, next day silver, then suddenly copper coins that look like they came free in a packet of Parlay G. Guess what? The poor stayed poor, the rich got richer, and retail kept crying. Exactly the same as today, just without Zeroda glitches. Then came banks. Oh yes, the trustworthy institutions. These guys were like that one friend who says, "Buy Paisa Rock Day, main safe Rakunga," and then spends it on Daru and betting. Banks took coins, stored them, and gave people receipts. Sounds genius? It was just a fancy IOU scam. And slowly, they turned into the official middlemen mafia. And here's the roast. Cardike would have been the idiot standing in line at a medieval bank, flexing his receipt like it's an NFT. Sudhanshu would have been calculating interest on coins with an abacus, still losing money. Retail clowns? They trusted banks like modern Indian parents trust engineering degrees. Blind faith, zero logic. So yes, introduction done. The rise of coins and banks wasn't humanity getting smarter. It was humanity signing the first chapter of the Chutia Retail Survival Guide. Nice. Section 4 deep dive coming in. Full Valhalla chaos, stupid-proof English, savage roasts for Cardike and Sudhanshu, and actual things you can use. Read it loud. Laugh, learn, don't be the retail clown. Section 4 deep dive. Paper money and banks, the middlemen mafia. Quick line. Receipts became money. Banks turned receipts into credit. Credit grew the world, but also created the greatest vehicle for stealth theft, modern banking. Same scam, prettier UI. Number 1, from coin to paper, the short, ugly story. People handed their coins to keepers, temples, goldsmiths, for safety. Keepers issued receipts. I owe you X gold. Those receipts started circulating instead of the metal. Receipts equals convenience, but also the birth of IOU money. You trusted a paper more than metal because the issuer seemed powerful. That trust is the magic sauce. Banks didn't sell metal, they sold faith. Roast? Cardike would clap at a receipt like it's a concert ticket. He'd learn the hard way. Number 2, fractional reserve banking. The engine and the trap. Bank sees not everyone withdraws at once, lend part of deposits. One deposit becomes many loans as receipts are redeposited, money multiplier. Growth, funds trade, industry, houses. Good. Fragility, if everyone asks for metal simultaneously, bank run. Bank hasn't the real metal to pay everyone. Simple math. Deposit 100, bank keeps 10% reserve, lends 90. That 90 becomes new deposits elsewhere. New 81 lendable. Money expands. Roast. Banks did leverage long before crypto bras. Same arrogance, different spreadsheets. Number 3. Bank runs, panics, and why trust matters more than gold. Runs happen when trust evaporates. Rumor, war, insolvency. Old style, people queue to withdraw. New style, one tweet freezes app withdrawals and panic spreads in minutes. Solutions historically, suspending convertibility, central bank lender of last resort, deposit insurance. Each solves panic but can create moral hazard. Lesson: liquidity, solvency. A solvent bank can still die from a liquidity run. 4. Central banks. Saviors or secret printers. Central bank roles. Issue currency, manage rates, act as lender of last resort, control inflation target. Tools. Interest rates, open market operations, buy-sell bonds, reserve requirements, QE, print and buy assets. Good, stabilizes system. Bad, printing too much equals stealth debasement. Low rates encourage leverage and asset bubbles. Roast, central banks are like surgeons who sometimes burn the house to stop a flea. Handy, but messy. Number 5, modern plumbing, shadow banking, repo, and the dark corners. Shadow banking, money market funds, hedge funds, non-bank lenders doing bank-like business without same rules. Repo market, short-term funding market. If repo dries, big players can't fund daily operations, stress spreads. OTC derivatives and leverage hide risk off balance sheet. When they fail, it's contagious. Godz Cameo, liquidity providers, market makers, LPs appear friendly until stress, then they vanish. When Godz leaves, the market collapses fast. Number 6, digital banks and fintech. Faster, slicker, but fragile. Pros, accessibility, UPI, speed, low friction. Cons, custody risk, operational outages, concentration risk, many users on few platforms, addiction to cheap funding. Exchange hacks, proof of reserves lies, and app freezes equals modern bank runs but with push notifications. Roast, Kardike thinks app balance equals real. One outage later, he learns tech doesn't equal custody. Numbers are 7, how banks actually profit and where retail loses. Interest spread, borrow cheap, deposits, lend higher, loans. Net interest margin equals profit. Fees and charges, every small thing is monetized. Securitization, sell loans to investors, move risk off balance sheet, works until it doesn't, 2008. Leverage, amplifies returns and risks. Retail pays, low deposit yields, high loan rates, hidden fees. Banks get scale plus safety nets. Guess who's comfortable? Number 8, classic failure modes. What kills banks? Bad loans plus falling asset prices equals insolvency. Funding shock, repo or deposit flight, sudden illiquidity. Counterparty failure, one big player collapses, dominoes. Confidence collapse, runs and regulator intervention. Real examples: 2008 global financial crisis, SVB-style funding squeezes, exchange collapses in crypto world. Number 9, what retail always does wrong and how to not be that idiot. Trust app blindly. Check custodian, insurance, proof of reserves. Use leverage without a plan. Margin equals fast poverty. Ignore funding markets. Repo spikes equals trouble. Assume regulation equals safety. Rules help, but they fail under stress. Do this instead. Diversify custodians, keep emergency cash, limit leverage, check bank fintech balance sheet health for major exposures. Number 10, quick survival checklist. Copy exactly. 1, don't keep all money in one bank app. Split across institutions. 2, if deposits leisure insurance limit, keep excess in diversified assets, T-bills, ultra-short funds. 3, monitor short-term funding rates, repo, interbank. Spikes equals tighten risk. 4, for fintech yield promises, read the counterparty risk. Who clears? Who insures? 5, have 1 to 3 months living expenses in ultra-liquid instruments, not app-locked investments. Use limit orders and size carefully in thin markets. Apps can freeze at worst moments. Number 11, tactical trades if banking stress appears. Move to short-duration treasuries, T-bills. Trim levered stock positions. Consider high-quality bank debt only if spreads widen convincingly. You know what you're doing. Increase cash buffer. Add hedges, index puts, for concentrated equity risk. Number 12, roast to Yellen class. Kardike kept all savings in a single app because UI was nice, cried when it froze. UX doesn't equal custody by. Sudhanshu trusts banks like family, then wonders why EME calls sound so familiar. Banks aren't family. Influencer bras sell fixed yield pools. It's bank light without regulation. Same con, fancy filters. 13, Valhalla mic drop, open quote. Banks turned trust into leverage and sold you the bill. Learn the plumbing, custody, funding, liquidity, or be the liquidity that funds someone else's yacht, close quote.